Okay, welcome everybody. Put down your pencils. Well, pick your pencils up. I'm not selling anything today. I'm here to give you some education. I've been doing this for a long time, 35 plus years. I'm a professional trader. At the point in my life where I get a kick out of working with people and teaching them how to be a success. A lot of the things our previous speaker just said are true. You've got to embrace losers. You've got to check your ego at the door. You've got to prepare. You've got to prepare for losing streaks. You've got to prepare when the market goes against you, because guess what? It will. This is a tough area to make money in. However, there are people, myself included, that do make a living out of this, and I get a big kick out of teaching people how to do this. It is not something that you pick up by reading a book over the weekend or going to a webinar. It's something that you have to hook up with somebody or come up with a rock solid strategy yourself and just keep it simple and execute it. Today, my topic is hedging your portfolio. A lot of people don't think about this, but the market does make corrections on a routine basis. Now, sure, the stock market has been in a crazy uptrend recently. Not recently, for the last couple years. However, we all know there will be a pullback. I don't know when that's going to happen. I don't think we're heading for a bear market anytime soon, because the interest rates are so low. There is no place for the very big boys, the institutions, the mutual funds, to park their money. They can't park their money at 1%. They just can't do it. They wouldn't have any people coming to them. So they have to be invested in the market. And this means that the bull market will continue as long as the Feds keep the interest rates low. So there is going to be a bull market for a long period of time here. I think maybe a couple years. Probably won't be as strong as it has been lately. However, there are times when we'll have corrections, and you as an investor who have worked hard to make that money in the market, when you do have a correction, need to have a tool to hedge your portfolio so you don't let your hard-earned money dwindle away. This is an investment strategy intended to offset potential losses. So what I'm going to talk about today, I'm going to talk about two indicators that I use. Like I mentioned, I like to keep things simple. I use the exponential moving average line along with the Fibonacci ratio. And I am going to explain the Fibonacci overextensions and how I use those. It's a very powerful tool. I use that in all my trading to tell me when to get out of a trade or when to enter a trade. We'll go over the hedging rules. I'll talk about the downside corrections, and really when we're in a bull market like this, the corrections usually occur in what I call a slow rollover. You are not going to see a quick reversal and a quick drop of 10% in a matter of a week. You're going to see a slow rollover of the bull, and then a correction, and then it'll be back off to the races. We'll talk about some of the hedge timing, that it's not real critical. Once you see this slow rollover, you can begin thinking about, does it make sense for me to hedge? We're going to use protective puts. We're going to use protective puts, and these are going to be ETF options, protective puts. I'm going to talk about whether I want to use in the money, out of the money, at the money, and how far out do I need that protection. And then we're going to go through 2016 step by step, an example of what I see, what I do, how I protect myself, and how I get back into the market. One of the keys to being a professional trader is low anxiety. You need to have a strategy that's going to allow you to stay in the market as long as it looks like it's running, and not be afraid of a correction. As a matter of fact, relish a correction, because we're going to increase our portfolio size when we sell the puts, and then when it goes back off to the races, we're going to be doing just fine. This strategy works equally as well when, I mean, I've tested this. I've been trading for a long time. 2008, it worked just wonderful. The beginning of 2009, it worked just wonderful. 2007, it worked just wonderful. 2000, at the beginning of the tech bubble burst, it worked just wonderful. It works just wonderful in 2016, which was a nice bullish year. Okay, so this is a tool that you can have in your back pocket and use whenever you feel it's necessary. Like Renee said, I've been trading for a long time. I'm a hedge fund manager. I'm a keynote speaker at a number of different locations. I've written 3 financial books. What I do right now is I'm the founder and head trader of what I believe is the absolute best stock option education website available today. We have a staff that does nothing but look at my competition, and we rate #1 as far as performance and customer service. When you become a member, you get my direct email. I answer your questions. Okay, I get a big kick, like I said right now, about teaching people how to be a success in this very, very difficult world of stock investing. Okay, simple exponential moving average. I look at the 8 and the 21 day. And you can see that I've got a chart here of 2017. You can see how here the green is the 8, and you can see when it's running, when the market is running, it stays above that 8 very nicely, very nicely. And then when it drops below, that potentially is a time where we want to hedge. And you look at this year was an extremely profitable and bullish year, but there were times when the hedge would have been the thing to do to cut your anxiety and increase your profits. So let's just take a quick look here at this period of time where you've got the 8 and the 21, and let's look at some Fibonacci's and how we would have used those. I use Thinkorswim. I'm not affiliated with Thinkorswim, but I happen to think they're one of the best trading platforms out there. Fibonacci's can be, all you have to do is go to the chart and go down to Fibonacci extension. And I'm going to explain what the Fibonacci's are and how they were developed, because it's a very powerful, it's not really an indicator, because it gives you a glimpse at what might happen in the future. If you use a measured move and go from a high to an intermediate low to a lower high and then a lower low, that's a classic definition of a downtrend. This is now a downtrend. Once you have this established, you can look at an overextension. This is a 161. That is an overextension. And the more I use these, the more I am just amazed at how it comes down, and within a couple ticks, we'll hit these. Now, I look at the 127, the 161, the 261. If it comes up to the 127, a lot of times it'll either consolidate, it'll pull back, or it'll blow right through it. If it blows right through it, it's probably going to go to the 161. Same thing is going to happen to the 161. If it blows right through there, it's probably going to go to the 261. But But I'm looking right now at the 8-day, and it came down below the 8-day, and right there, my ears perk up, and I said, okay, it's time for me to protect my hard-earned money. And I'm going to put on a hedge, okay? And then it crosses below the 21-day, and that confirms that what I've got is good. I'm just going to hang in there. But all of a sudden it comes down to the 161, and I say to myself, you know, it blew right through the 127. It came down to the 161. There's a good possibility this is going to reverse. This is going to reverse, and maybe it's time for me to take my hedge off. Well, right around here was a great time for me to take my hedge off. So I've protected my portfolio from here to here. Well, that reduces a lot of anxiety. It reduces a lot of loss in your portfolio. And if you take the profit that you made on your protected puts and reinvest that, you're ready to rock and roll when it turns around. Okay, and that's how I use the two indicators. It's very, very easy. Let's go over to measure move again. Measure move is very powerful. The definition of a trend, an uptrend, is higher highs with higher lows. And as long as the market is in an uptrend, it will stay within that. It will stay in an uptrend until it makes a reversal. And you can see a reversal when you get a bearish measured move, and that is a downtrend. It's lower lows and lower highs. And you can use this on any time frame. On any time frame. Okay, if you're a very short-term trader, you can use this on a tick chart. You can use this on a 1-minute chart, a 2-minute chart, and see when the short-term bullish moves are and the short-term bearish moves are. You can use this on weekly charts and look where the longer term is. But basically, if you have the market coming down and it hits a low, and then it comes back up, pulls back, but makes a higher low, then moves back up and makes a higher high. Higher highs, higher lows. This is the classic definition of an uptrend. This is the beginning of an uptrend. And a lot of times in a bull market, you'll have any number of these as you're moving on up. Then along you get to the top, and it pulls back a little bit, and you're saying, well, okay, is this potentially a pullback and it's going to push on up? And it doesn't. It doesn't push on up. It makes a lower high, a lower high. Then it makes a lower low. This guy, this bull move has just reversed to a bear move. And like I said, you can use this on any time frame. We need to have a measured move before I can apply Fibonacci's, because what I'm going to do is I'm going to click here, drag to here, click here, drag to here, and the Fibonacci's are automatically applied to my charts. It's an awesome tool. It's an awesome tool. Let's talk a little bit about the Fibonacci's. The Fibonacci ratio. The Fibonacci ratio is seen throughout nature. The stem of a flower, the leaves grow proportionally to the distance of a Fibonacci ratio. The spiral on seashells are proportional to the Fibonacci ratio. The distance of the human bones, the human forearm to your hand is proportional to the Fibonacci ratio. My hand is 7.5 inches. My forearm is 12.3 inches. I'm 6'5", so I've got pretty big bones. When I divide my forearm into my hand, I get 0.61. That is the golden ratio. That's the Fibonacci ratio. And so are all your other major bones, et cetera, et cetera. So doesn't it make perfect sense that the market would move in perfect harmony with nature? I mean, what fuels the stock market other than human fear and greed? Human fear and greed is what fuels the market. Let's dig into this a little bit. Fibonacci came up with a number sequence. And the number sequence, it was you take any two numbers and you add them together and you get this number. 1 plus 2 is 3. 2 plus 3 is 5. 3 plus 5 is 8, and so on and so forth, okay? If you divide any of the numbers here by the preceding number, you get 0.618, which is the root Fibonacci ratio. Now, mathematicians came along and they like to square things and take the square root of things and then further take reciprocals of those. And you come up with the 127, the 161, and the 261, and I use those for extensions. They are a powerful indication of where the market might stall or turn around, where it might be overextended. So I'm using both the 21-day exponential moving average along with the Fibonacci's to project when to get in and when to get out. Here's the rules. It's a simple flow chart. When the price crosses above, when the 8-day crosses above the 21-day and closes greater than the 21-day, you want to take your hedge off. You're in good shape. We'll let her go. And as long as the price closes above the 8-day exponential moving average line, you don't have anything to do. Just let your profits run. As soon as it closes below the 8-day exponential moving average line, it's time to put a hedge on, or at least get ready. Think about it. You can watch the market a little bit and then put it on. Once you have that hedge on, if the price closes below the 21-day, yes, keep it on. No, price closes above the 8-day exponential moving average, take it off. Okay, if you still have it on and we come up here and the 8-day crosses the 21-day, you take it off. Okay, so this simple flow chart shows you when to put a hedge on and when to take it off. The caveat being, if you utilize the fibs, you can do an early hedge signal on or off, on or off. It's pretty simple. It's pretty simple. You've got this portfolio that you've worked so hard to develop, and now all of a sudden the market's going against you, and you want to protect that, and you're going to use a couple indicators to protect that, and you're going to hedge it, and when it turns around, you're going to take the hedge off. Now, let's talk about the slow rollover. It usually averages about 4.5 weeks before the market finally takes a dip. Finally takes a dip. This was a short rollover. Look at this rollover. Look at this slow rollover. The market's kind of meandering around. You want to put your hedge on. You got your hedge on. Boy, am I glad I have my hedge on. Oh, we're down to a Fibonacci. I'm taking it off. And it rolls over again, says, I might put my hedge on again. Okay, do it. And then comes down here to a Fibonacci, take it off, and then up we go. Okay, it's a slow roll. This is not something where you have to watch tick by tick and watch it every day. This is great for the working person that has a nice portfolio that wants to save their money and wants to protect it and wants to have it grow. 2014, just for an example, we had 4 rollovers. You can see the first one here, the second one here, 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 and here. Okay, so I'm not going to spend a lot of time on this, but the first one was a 12-day rollover, and if I bought it when I originally saw it drop down, I would have gotten the February 182 put, protective put, at 281 and sold it for 729. If I would have waited all the way till the 22nd, I would have sold or bought a February 185 put for 249 and sold it for 10. It didn't make much difference at all. And that's the beauty of it. If you see the market turning against you, you can say, well, I'm going to watch it for a while, or you know, whatever you want to do. You've got time. You don't have to jump immediately. You don't have to like wring your hands about, oh, you know, what happens if I don't do this? Okay. The second one was a 3-day rollover, but it didn't make any difference whether you took it right at the beginning or right at the end. This third one was a 7-day rollover, and once again, it didn't make any difference on if you got in on July 16th, you would have paid $3.40, got out with $7.63. If you waited 7 days later, you would have gotten in for $3.60, got out at $7.63. Now you say, well, that's 10% different. We're looking at 100% gain by hedging your portfolio. 10% doesn't make any difference to me at all, at all. Okay. If you had a $100,000 portfolio, you would get 10 contracts to protect that, and you would have $4,190. And what are you going to do with that? What you're going to do with that is you're going to buy more shares. Because when you take the hedge off, you're now going to be at a lower position and you're buying more shares. So when the market takes off again, you're going to be right there with it, and you're going to have more shares. How far out do I put on these protective puts? In 2008, the average that I would have used was about 2 months. More recent, it's more like 1 month. So to cover all the bases, I use options between 45 and 65 days until expiration. Lately, with the market being so strong, you don't have to go out that far. The further out you go with an option, the more you're going to pay for it. But lately, it's been so powerful, you don't have to go out that far. This is just an example, again, back in 2014, looking at the 17 October, which was 45 days away. We looked at the 200 put, and it was worth $3.22. Okay. Now, look at this right here. This is delta. The easiest, the layman's definition of delta would be it's the percent move that the option will make when the underlying moves $1 or 1. Okay, so for here at the money, and at the money is always going to be right around 50, 51, 52%. So you're basically getting in and you're hedging your portfolio with enough ETFs to hedge half of it, only half of it. Now, this is important because what happens if you're totally wrong and the market doesn't drop, but it continues to rise? That's fantastic. Your portfolio is increasing. You've got protective puts, but they're only moving 50 cents to $1. And if it moves against you, you just take them off. You take them off. Okay, so you've got excellent coverage, and it's no big deal if it goes against you. Now, if it goes with you and it drops, see, now all of a sudden the delta has gone from 0.5 to 1. So it's for every dollar that the stock moves, the option's going to move $1. All right. So and now we need it, because before it was at 200, and now it's down to 193. But we've made this amount of money, $6.69, and we've got full coverage. As the market goes down, your protective puts increase in value, and your insurance, if you will, increases. Okay, Which ETFs do I use? Three. There's three of them. S&P 500, the SPY. QQQ, the NASDAQ 100. IWM, or the RUT, Russell 2000. That covers 2,600 out of the 7,500 publicly traded corporations. Put your portfolio together. See what stocks you have. Are they in the S&P 500? Are they NASDAQ stocks? Are they Russell 2000? Hedge your portfolio on the S&P with the SPY or SPX if you want to go with a big boy. Q's on the NASDAQ, IWM or the RUT on the Russell 2000. So let's just talk about the hedging process. And what we're going to look at is this period right here where it dropped down below. After sticking around for about 8 days, we finally said, hey, let's put a hedge on. We put a hedge on, down it went. We came down to this point here at which we took the hedge off. So let's take a look at the process. The process was on December 16th. The SPY was at 205. Now assume I had a $100,000 portfolio in the SPY. This can be any number your portfolio is. You can use this equation to size it for any portfolio you have. So if the SPY is at 205, I had 488 shares on December 16th. Now, December 16th, I decided to hedge. So what I did is I bought 5 February 2005 puts, at the money puts. And I paid $6.38 for those. 5 contracts times $638 is $3,190 if it goes all the way till expiration and expires worthless. We're not going to do that. If it goes against you and the market just takes off, go ahead and sell it. You've made money on your large portfolio. You've only lost on the insurance, and it was only 50%, so you've made 50%. That's not bad. That's not bad. Well, we held this until January 20th, at which point we sold this guy right here for $19.42. $19.42 minus the 638 times the 5 contracts gave us a $6,520 profit. Okay, at that point in time, the SPY was at 185. I bought 35 additional shares, added to the 488. Now I had 523 shares at 185, or 97,000. I lost a little bit. I lost a little bit, but now I have more shares than I had here. I protected my large portfolio. I have more shares, and now I'm ready to go when the market turns around. Protect your portfolio. Hedge. I don't care how large your portfolio is. It's very important for you to protect your hard-earned money. This is a very easy strategy. This is something that you can do time and time again. If you're wrong and the market goes up, you're still making money with your larger portfolio. You're just losing 50% of it, 50% of the put value. So if the market goes up at $10,000, you've lost $5,000 on the puts. You've still made $5,000. Okay, so if you're completely wrong and put a hedge on when it's not the right time, you actually make money anyhow. But if you're right, you totally protect your portfolio. Now, a lot of people say, well, I don't have that kind of a portfolio. This can be used for any size. And what I'm hoping that all of you will increase your portfolio size till one day, and by that time you'll be so proficient at this, you'll be able to do this all the time. That's what my hope is. Okay. Now, I would be remiss if I didn't go to the best website available today, and that is www.optionsinfinity.com, and show you what we've got. So let me see if I can bring that up. And let's go over here. There we go. And let me expand that out. Okay. Okay. I do see a couple questions here, but to be quite honest with you, it would be hard for me to. And let's see. Let's see if I can try to make out these questions. I wish I could expand this a little bit. Let's see. The first one was okay, no rain. Okay. Here we are at www.optionsinfinity.com. The first thing I'd like to do is, you can tell I'm passionate about teaching people how to do this. And I want you to become a free member. All you do is click this button and you have access to all this stuff. These are webinars that I did on Options 101. The advantages of options, the leverage, the psychology of trading. Remember somebody earlier said that trading is 90% mental and 10% indicators. I think it's at least 50-50. And that is the psychology of trading, and very few people talk about that. And I've got a webinar in here talking exactly about that. I talk about how I set up my charts. What's the proper trade size for any portfolio you have, so that you can take a loss, you can take a number of losses, and you just execute the trades. I talk about again about the trading psychology. Love the regression channel. Love the regression channel. The regression channel basically is the regression line is calculated by 50% above, 50% below the price. So it's a great trend line, and then statisticians look at the ±1, ±2 standard deviation. When the stock or the market is up around the +2 standard deviation, there's a good possibility it's going to revert back. That's what they call overextended, overbought. And I talked to you about regression channels. Here's more on Fibonacci's. This is an indicator that I developed. This is the daily version of the weekly MACD. Talk about the money flow index and economic exponential moving average lines. Now, if you choose, and what I'd like to do is have you become a member, get in there, play around, listen to me, see if all this makes sense. See if what I do makes sense to you. I've been trading for a long time, and the one strategy that I think puts you at an advantage, at an edge, is credit spreads. Credit spreads is where you sell one out of the money and buy one further out of the money for protection. When you do that, you are basically like the house at a casino. Okay? The odds are in your favor. With credit spreads, if you do a bull put, which is a bullish strategy, and the market goes up, you're a winner. If the market goes sideways, you're a winner. If the market comes down, but not a lot, you're a winner. If you do a bear call, which is a bearish strategy, if the market goes down, you're a winner. If it goes sideways, you're a winner. If it goes up just a little bit, you're a winner. How can you beat that? Credit spreads are the absolute best way for you to trade the market. credit spreads are the absolute best way for you to trade the market. Now, there's two programs that I have. One is Options Pro, one is SPX War. Options Pro, what we're doing is we focus on the big, what I call the big five, and they are Amazon, Priceline, Google, RUT, and the SPX. Why do I use those? Because they are over $500, and the credit that you receive is a lot more than you do for a $50 stock. So yeah, you can get the same amount if you trade $50 stocks, but you're going to need about 10 of them. Well, that's going to require more commission. So why not trade the big boys? Not only that, why not focus on 5 stocks that you really can know well? Okay. These are usually, we have about 30 days till expiration. This is a good program for those that work during the day. The SPX trades the SPX weekly options. It's a little faster pace. It's the trades usually only last a couple days. It's perfect for traders looking for quick profits and shorter hold times, smaller accounts, people that are just trying to build things up. Okay, they both have exceptional returns, the best in the industry. Okay, so what I'd like you to do is become a free member, learn about me, learn about what goes on, and if you like it, why don't you try choosing one of these two? And what you get is you get a 4-part video course where I teach you exactly what I do, how to set up the charts, everything. We got a nightly video blog that is put right on the website. You take a look at it. We review all current trades and all what we're going to be doing in the future, what the market's looking like. Once a month, we have a Q&A session with me. I answer all your questions, go over all the previous trades. And then when I see a trade, you'll get a text and email alert. Now, I'm not a registered investment advisor or a licensed broker. So when I send out an email alert, that basically is telling you that's what I do. That's what I do. You have to make the decision what you want to do. Okay. All right. Let's see if there's no other questions. And like I said, this was basically for your education. You know, hedging can be done with any size portfolio. I think it's a marvelous thing. I used to have a program where I actually sent out real-time text alerts when to hedge and when not to. But I think it's of so much value that I want to teach everybody about it. There is a blog. Actually, it's under courses, and that's free. You go under courses, and you can see that I've put that together in a 2-part webinar for you. I try to give out a lot of information. I try to have you see whether what I'm doing makes sense and whether I'm your mentor. Do you want me for a mentor? And then try one of these programs. Like I said, they're the best in the industry. I've got higher returns, the best performance available today.